Welcome to Breakout Investors. Today we are speaking with the management of Iridex, ticker IRIX, specifically the company's CEO, Dave Bruce. Joining me on today's call is Breakout investor Aaron Warwick. This call is being recorded on June 14th, 2022, and will be distributed via the Breakout Investor channel on our YouTube and via our podcasting network. Look for Breakout Investor content wherever you subscribe to podcasts. We are on Apple, Spotify, Audible, and most other platforms. Supporting material for today's discussion will be posted on the Breakout Investors Collaboration app, available in the App Store at app.breakoutinvestors.com as well. The application and much of the research content is free. After registering or logging in, use the search bar at the top right of any page, type in the ticker, and the results will give you a link to the research posts for this presentation and to other discussion and research relating to today's company. Those of you already on the platform can share your questions for the company using the Discuss tab in Aaron's Breakout Investor Room. So let's get the call started with me handing it over to Aaron.
Hey, thank you, Josh. I'm actually going to hand it over right away to Mr. Bruce. He's going to give us a brief update on the company. He has presented for Breakout Investors before. And then I'm going to pop on screen and do a little bit of Q&A. So Dave, thanks for joining us today, and I'll give the floor to you.
Excellent. Thank you, Aaron, and thanks everyone for joining. Appreciate your interest in Iridex. I'm going to spend just a couple of minutes and talk about some of the highlights that we presented in our first quarter conference call. That was about a month ago or so. We achieved record first quarter revenue, about $13.4 million, up 12% from the prior year. Good strength in our retina business and 8% growth in our probe business. We still see higher growth in the probe business, but there was some early first quarter impact from COVID, both domestically and worldwide. We saw a nice rebound domestically in March, and probably more prolonged internationally. And so we posted 8%, again, greater strength in the U.S. than internationally. Retina product grew 10% year over year, which has been strong. If you recall, retina is a good story from the post-TopCon collaboration that we established last year. We had been declining low single digits year over year in the retina business. We revitalized some investments in that space. We split our sales team, so we have a focus on both glaucoma with a dedicated team and retina with a dedicated team. And then we added the Pascal product line from TopCon, which was a competitor to our scanning laser offering. Now we've got both of those, and we turned a competitor in TopCon to a collaborator. So that's been a success for us, and the team has been performing very well on the retina side of the business, which is a higher percentage of our business, but we've turned that from a slow decliner to a grower at or ahead of the low single digit overall market growth rate for retina laser systems. Our cash usage in the first quarter was $3.2 million, a little bit higher than our typical usage rate, and that's accounted for by a shift we made essentially to address all the challenges in supply chain that I'm sure you've been hearing about from everyone, not just in the medical device space. So we increased our inventory somewhat, and we prepaid some expenses that will be delivered later this year, all in the name of assuring supply or having more on hand to meet. And that was about $2 million worth of incremental shift from essentially cash in current assets to inventory and prepaid expenses. And we're hoping those things unwind as we go forward, and we can be leaner in our inventories and current assets. We aren't seeing any significant move year to date in easing of the supply chain, so we're still very focused. And we've been fortunate; we haven't had a significant effect from supply chain in our revenue reporting, at least not so far. So that puts us in good shape to grow through the rest of the year. Just a slight note on quarter-to-date experience. I'd say internationally, we've seen a better rebound, but still, COVID persists. And I know, at least for me, anecdotally, I probably know more people in the last 1 to 2 months that have come down with COVID than all the rest of the period. It's much less severe, but it's really spreading around. And at the margin, it affects people's interest in going to their doctors or having a procedure done. And, we think that will lift over time, but we see, some impact from that in, kind of a wet blanket effect on international. We are focused and penetrating in the glaucoma space by enhancing our clinical evidence, driving a better presentation from clinicians talking about our TLT procedure in terms of desired targeted patients, as well as the key dosing, as we call it. What's critical in effectiveness is getting the formula right, sweep speed and energy and repetitions to get good outcomes and good durability of those outcomes. And we continue to invest in that area. We have split the sales team and are driving the U.S. glaucoma team up this year. We finished last year with 11 territories. We are up to 13 now and expect to expand to 15 by the end of the year. We're making these expansions and investments, really trying to invest the incremental gross margin dollars we expect to earn this year versus last year, invest those incremental incomes, and keep our cash usage in a very controlled level. I'd say the investor questions around cash usage and break even are much elevated in the last 6 months as the market has somewhat punished the cash burning entities out there, and people are focused on that. And we finished the year with almost 24 million. We finished the quarter 20.5 or so, and we're staying focused on driving the growth areas where we think we're making an impact, but also keeping an eye on cash and an extended runway for the company with the cash that we have on hand. We have ramped up our peer-to-peer training programs for physicians on a web-based presentation with follow-up proctoring of cases from our team. And we continue to roll out our updated, what we call sweep management software, which aids the clinician in selecting the right parameters and then conducting the procedure with those right parameters. And that'll continue throughout the course of the year. We finished last year with about 2,100 glaucoma sites worldwide. Our guidance for this year is to increase that by about 225 to 250. And that'd be about, say, 60-40 outside the U.S. versus inside the U.S. We think we're still in the early stages of adoption when we look at the size of the potential pool of patients who could benefit and should have the benefit of MicroPulse TLT in the course of their continuum of managing glaucoma over their lifetime in conjunction with their clinician. And we're driving up those areas where we think increases that penetration. So we confirmed our guidance after last quarter, and we think that's going to lead us to on the order of 18% growth in the U.S., 18% growth in glaucoma probes, led by the U.S., and overall 57 to 59 million of revenue, up from a little below 54 million in 2021. And then finally, we have talked about launching our newer platform which is both incremental feature improvements as well as cost reductions in the laser system, and those will be launched later this year, fall trade shows, and be available starting in the U.S. During the fourth quarter. So with that, I know, Aaron, you had some questions, and if there are questions from the group, I'd be happy to spend a lot of time either expanding on that or getting to the questions at hand.
Yeah, thanks, Dave. I appreciate that background. I guess my first question would be about today. You just announced that you've got regulatory clearance for the Cyclo G6, your glaucoma platform in China. And so could you just maybe touch on that briefly?
Sure.
Significance of
on the way, I guess that would have been a good highlight to put during the overview. Yeah, so we've been seeking Chinese approval for over 2 years, really, and it seems to be a little bit of I'd say a trade barrier that they're using, because
Sure.
We're not unique in that in terms of the various companies trying to introduce new products into China. But we're very pleased that it finally got it over the finish line. So we will roll out starting in third quarter. So we're a couple weeks away from the end of this quarter.
Right.
We'll roll out in the third quarter with our partner Topcon and Clinico, who distributes all of our laser systems in Greater China. And we'll start with a kind of the classic approach to seeding with KOLs and getting them experienced, some of the key hospitals and users on board, and expand. But it's a very large opportunity. In the press release, we referenced a couple of studies that look at the Chinese market and see 500+ million adults above age 40, 2 to 4% glaucoma population in that. So something on the order of 9 million patients. One study said there's 9 million patients with glaucoma. Contrast that with the U.S., where there are 6 million. It's a fantastic opportunity. We've been eager to get going. Of course, we want to launch it the right way. So given our experience that it takes training, education, and essentially proctoring to really be sure that clinicians are conducting the procedure the right way, therefore getting the outcomes, safety, and durability that we all seek. We'll make sure that we do that in a controlled fashion to begin with.
So is there, in China, is the current treatment for glaucoma basically similar to what it is in the U.S.? Is it pretty standard of care here, pretty similar there, or what is the situation?
China is generally, a multi-tiered economic society. So, I'll call it at the premium end of that marketplace. It's very U.S.-like. I don't know the exact penetration of, say, the MIGS style procedures in conjunction with cataract, or the premium IOL penetration in the segments in China. But there's a very large premium segment, and that premium segment tends to track the U.S. and frankly prefers U.S. products, or call it world leader products, whether they're European or a U.S. And so we think that that's a very large opportunity to get started. Of course, we'd be opportunistic as the marketplace demonstrates demand in lesser tiers.
And I imagine, that should be a major market for Topcon, right?
So Topcon has a very specific focus. They used to use distribution there. They went direct with their diagnostic products. And based on the opportunity, they wanted to build up a direct team. They're Chinese on the team, but they are direct employees of Topcon. And at least to begin with, our partnership with Topcon incorporates Clinico, which was our distributor prior to the deal with Topcon. Clinico actually started, and as with a lot of companies, the local distributor is the one that drives the approvals process. And so Clinico was driving the approval process. They have other complementary products in the space. They sell some disposable products in China, and so it's a natural to continue with them and use their leverage and experience with Iridex products to launch the market and start to penetrate in the early years.
Can you, speaking of TopCon, can you talk a little bit more about that relationship? I think it's been about a year now. How's that going, and how much upside have you seen already versus what you think there could be over, say, the next 1, 2, 3 years?
It launched quite nicely. We saw a few challenges that were potential things we had to pay attention to. Number one, shifting distributors, right? So just to remind, so TopCon purchased the distribution rights for Iridex products primarily in the Asia Pacific and EMEA regions, which is about half of our OUS distribution. Now, they have a combination of direct and also sub-distributors. Some of our distributors became sub-distributors. So it wasn't a complete changeover of call it sales reps with the different products, but there was a substantial portion that was. So there are two challenges as you change distributors. Number one, you have to do the transition from the old to the new, and we were quite smooth in the wind down where we were discontinuing with some partners, and then work on training and kind of in the field with new products. TopCon already sold Pascal, but the rest of the Iridex product line in retina was new, and the glaucoma side with probes and disposables was new as well. And so in a lot of those situations, it's not a 1 quarter event to give them some training and then boom, off and in the shoes. So it was a phased conversion. We finished the final country, which was Japan, ironically, in the first quarter. And so now the old distributor is wound down. It's in the hands of TopCon. We are, furiously doing training programs in various regions. I think we talked about the few that we did in Europe and EMEA. And in this quarter, we're rolling to Japan and Singapore, which is their base for the rest of Asia. It's a period to bring them up to speed. And we talked about this from the beginning. So I think there's some, good growth upside as we move through those trainings. Those reps get experience, and, experience with success, which kind of can reinforce those efforts going forward. So we don't think we're hitting on all cylinders there yet. Our numbers are pretty good, but we think that there's some upside. Look, there's still going to be turbulence back and forth. At the end of the day, the individual countries or the managements in those countries have to, allocate and put the plans in place for their reps to drive that business. Sub-distributors, same thing, and that's a building process. So even though we're about a year down the pathway, I think probably most important is focusing on the glaucoma selling process and kind of stepping in the shoes. And we think that's an ongoing process. We're very focused on it. And we're quite, I'd say, confident that they will come up to speed. They bought the rights to distribute, and they, bought about 10% of Iridex. So they didn't do this to, just, pick up whatever they could pick up incrementally. So there's still work to be done, we think, and therefore there's some incremental growth to be achieved in that partnership.
I think one of the things you had mentioned when they bought this 10% stake and the distribution rights, it gave you some cash, gave you some flexibility, I guess, in terms of your operations and not having to worry about running out of cash. And one of the things that you said that you were going to do is split up the sales force, one focused on retina and the other on glaucoma. They're quite different approaches, as I understand it, in terms of the needs and how you would sell that product and the follow-up and so forth. So how is that going, and what kind of results are you seeing there?
Yeah, we split the teams in the U.S. Last year and started with a target for 12 territories in the U.S. on the glaucoma side and 6 territories in retina. The prior structure was a total of 12 reps hybrid, selling both retina and glaucoma. So retina is a capital equipment sale, which is quite different from a disposable and adoption-driven sale process. It's mature, it's competitive, so it really is a different sale. We always wanted to be able to take that step, but in the interest of controlling the cash burn and making the shift we needed to make in the glaucoma side of the business and frankly the retina side of the business, it kind of made sense. Let's keep that together until we're ready to make those pushes into the marketplace. So we split last year, and I'll start with retina. So we have 6 territories to cover the U.S., which doesn't sound like all that much, but our team hit the ground running. Iridex enjoys a premium position in the marketplace, both in pricing and preference. And so we see a lot of the deals. And so our opportunity to have, a group of individuals in their territory focused on capturing that has really paid off for us. Now, in the meantime, we had improved a couple of our product areas, so we had a better offering. And the combination of those two really has shifted us from a slow decline to growth. So we went from, say, -5% to a positive 3 or 4% in the U.S. in what's a mature segment. So we're pleased with that, and we think that will continue. On the glaucoma side, with about 12 territories, but we were down. We probably really only had 10 or short 2 to start out. We had to hire, and in the course of the year, we lost some reps. There was some turnover. Some was, we think we can, improve this territory, the selling skills of the individual in the territory, more focused on what we're trying to accomplish. And some went to, other opportunities. Our plan is, we finished the year I think at 11. We're up to 13 now, and we'll continue to grow. And what we find is that the newer reps take some time to come up to speed, as you could imagine. The complexity is not that high in our product, but in the space, there's a lot of choices. There's 4 or 5 different providers of MIGs, and they're each kind of expanding into the other's territory. And while we're not direct competitors with those devices concomitant with cataract surgery, although we do have some practitioners who prefer our device concomitant, we're really the rest of those procedures where they don't need cataract surgery, but they need something. And you can use our micropulse TLC procedure to buy 18 to 24 months of IOP reduction with a non-incisional procedure. So by coming up to speed, I mean not just learning our product and the right techniques and education necessary to bring someone down their pathway to adopt, but also dealing with what's effectively a bombardment of noise in the marketplace on our target clinicians. When you add up the reps of those, say just the MIGS devices, they're probably 10 to 1 to our reps in calling on the target clinician. So there's a distraction factor that we have to work through, and the long and the short of it is, we have some more mature, very strong performing territories, and we have some opportunities to bring less mature territories up and increase our usage rate. You know, one data point we looked at is if we had our territories all kind of up to the median or better, you know, there's incremental, 5 to 8% growth accomplished just in call it territory improvement. So we think that that's very achievable. It's one of the things we're focused on for improving our growth.
You had mentioned earlier about COVID, and obviously, like in the first quarter of this year, the beginning of the year, it was kind of bad again in terms of the number of cases. And even now, as you noted earlier, there's been sort of a spike in cases. But in terms of the disruptions, are you seeing any of the disruptions going on now that were going on earlier in the year? Is that kind of probably behind us?
I'd say it's subsided substantially. Like I was trying to describe, there's still staff that is sick, and then they don't have the capacity for that day. Patients who either want to avoid getting sick, I'll wait, let's reschedule it for later. It's not dramatic the way it was. For example, the original shutdown was
right.
A dramatic dip, and I think we went down to about 20% of the procedure volume at the very trough, but had a nice rebound. The first half of the first quarter, we saw more of that kind of suppression, not down to 20%, but down more significantly, and then had strength in March in the U.S. It is internationally, it's been I'll say a softer recovery, steady but softer recovery, and we think that is going to go away, but there's still a little bit of it out there, and it's hard to quantify it and say, oh, well, gee, that was worth 4 percentage points of growth.
Yeah,
but there's definitely an effect there.
Well, the fact that you can't quantify it as easily indicates it's not as bad, I think. So.
Yeah. So, we're optimistic that we can, we just keep driving where we can drive, get the access and usage. To us, it's, targeting really a three-pronged growth opportunity in glaucoma in particular. Number one is our existing users who are happy with the procedure but might be using us on later stage, which is where kind of the initial adoption occurred, where we belong in that more moderate stage. If we started the pitch with the efficacy, safety profile, and durability, you could conclude it's perfect for those moderate stage pre-incisional patients. So moving our existing happy users to a broader patient profile. And we think, a number of the things we're doing are working in that front. As we track the cases that we do in validations, if we're trying to move a new customer to adoption, a higher and higher percentage of those procedures are pre-incisional procedures. We track those, so that's happening. And then secondly, the consensus panel that we commissioned to take a look at MicroPulse TLT, what's the current state of the art, address the patient profile where this should be used, and they recommended that it should be pre-incisional. After you've tried drops, maybe SLT, pressures are rising, this should be a consideration, and that's that kind of mid part of the continuum of a glaucoma patient's care. Second leg of growth is in surgeon centers where we already have a laser system. There are still a number of users of that surgeon center that don't use MicroPulse TLT. We typically have 1, 2, or 3, and there may be 6, 8, or 10 users of a surgeon center. So bringing incremental users on in a surgeon center is a focus for us, and part of the targeting that our team does in the U.S. So that's 2 legs of growth that don't require selling an incremental laser system. And the third is kind of the traditional, get a new site, a new couple of users, sell a laser system, and then bring them up to speed. So that three-legged stool, as I describe it to our sales team, is what we're using to drive our growth in the U.S. And that's what we guide the distributors and train them on the process and both the targeting and how to bring people along in the international distribution channel as well.
I was wondering, as it relates to the growth, I wanted to ask you about, you've got, strong balance sheet right now. You had, I think it was 20 million plus of cash on hand at the end of the quarter, end of first quarter. You had mentioned even your cash burn was higher than it will be because of the, supply chain stuff and preparing yourself for that, which it seems like is a, really wise move. But how do you plan to use that cash to increase the growth and the market share, here in the, say, over the next 6 to 12 months?
I alluded to the idea that all of a sudden cash is king, and you hear everything from the the venture capitalists advising their companies, pare back your targets and go to those few that are going to be revenue and potentially cash generating or cash burn mitigating in the short term, which is a complete shift from 6 months ago when that's the core question. Like, you have this 20 plus million, your procedure sounds great, why not spend it all and grow as fast as you can grow and then go out and replenish. And our response was, look, we want to incrementally invest. We always want to maintain I'll say a diligent amount of runway so that if surprises come along, we're not beholden to go to the market at an inopportune time. But it's sure seems to be an inopportune time. We don't need to go to the markets right now, but I think that's part of what we did. I think in general, not speaking for investors, I think you guys tell me, but I do think we're kind of in that bucket of cash burning micro cap companies that are not in favor at the moment. And I think it behooves us to kind of be conservative in our runway. So we are upping our investment this year, as I mentioned. With the incremental gross margin dollars, we're putting several million extra into sales, marketing, and clinical because we think those are the areas that drive our growth. We will manage through this year and make another decision on it next year. When you look at our cash burn, I think last year we burned about 5.5 million. If by implication we're in that same range this year, we're spending the incremental gross margin dollars. That puts us still in the high teens with, even if we chose to continue that same level of burn, we have multi-year runway. Right. So we'll be opportunistic. We want to invest more where the opportunities warrant it. And as we see traction improving, it may make sense to, expand the sales team, expand our promotional activities. So, one big push for us is in the comprehensive ophthalmologist subspecialty. They do a lot of the cataract surgery procedures. Mm-hmm. They have the lion's share of the MIGS surgery is being done by that category of specialists. They have a lot of glaucoma patients that they're managing in the mild and moderate stage. And if they progress, they may refer them over to glaucoma specialists to manage as they get more complex. That's a great target for us, and that's a kind of a different community to target. So spending investments in everything from the periodicals and journals that they read to the web-based things that they do, and using KOLs from that space to promote is areas of investment that we're making this year, and expect that to pay fruit and look to expand that next year.
Is that? I mean, I guess final question for me is I did want to ask about kind of what you're hearing about as it relates to the stock price. I mean, obviously it was almost at $10 not that long ago, and we're down at 275 range now. What are you hearing? Is it mostly? I mean, and there's of course been market weakness, but it seems like your stock has been punished even more so. What are you hearing in terms of the reasons for that?
Yeah, well, I'll tell you what I'm hearing. But look, my observation is we were, bouncing above $9 in, what was it, November, when we announced our third quarter results, which was a beat and a raise of guidance.
Mm-hmm.
And the stock immediately started to sell down. And others had been doing that. I have a non-scientific list of microcap med tech devices
yeah.
that I look at, and I'm sure
all of us on this call probably have a similar list. So.
And they really had gotten hammered, at a much quicker rate than ours has been, disappointingly steady to the downside.
Yeah, that's true.
My observation is I haven't seen in the SEC reporting that funds have to do that, there was any big selling of our holders. In fact, I think there was more buying than selling in the last 13 and Fs that had to be filed in May
Mm-hmm.
for the fourth quarter, or sorry, for the first quarter. And I'm not hearing anyone attacking anything strategically. Of course, I think people are saying, boy, it would be nice to hear greater growth in the glaucoma side of things. It seems like things are going really well on the retina side of things, but nothing to the point that would drive people to determine at this valuation I'm selling. So I really, my sense, and what I do hear from a number of investors, not that they're doing it, but the category is being sold. Cash burning, microcap, med tech is being sold. You're in that category, and therefore you're being sold. And it's not a look at the tape to see what's the price today, should I sell? It's, I'm getting out of this in a, orderly or disorderly fashion, and we're being sold. That's what I'm hearing. But I'd like to hear from your group on views that that might do that. I do also recall, we were exceedingly cheap through all of 2020.
Oh yeah.
At the end of the year, we put out a little press release that we were now in the European Glaucoma Society guidelines for the continuum of glaucoma care, and there were maybe some other non-Wall Street analyst type people who wrote up some analyses of Iridex, and all of a sudden, people recognized and started buying, and that drove it up, and was was part of the recognition. I think a lot of that has unwound. I think our value is fantastic. We've had a couple of our directors dabbling in purchases. Not that that's a major driver of stock demand, but it is an indication. And look, our job is to manage the company to drive value, try to communicate the story, and let people make their decisions. And sometimes they pay attention and sometimes they don't. We didn't get much of a move out of the China announcement.
Yeah, that was shocking. I mean, really, I thought it up significantly.
That's now the clock can start on growth in China, whereas before it was when is it? So I don't know if that's an indication that nobody's really paying that much attention at this point in time. We're as focused as ever on driving the value levers that we can control.
I mean, it seems like you basically doubled your total addressable market or more just from the China deal in glaucoma. Yeah,
the China total opportunity is bigger than the U.S. opportunity, which is our biggest. But I don't I don't think it's a doubling overall, but it's a significant increase over our biggest market. Now, the economics of China, you've got to lop off some portion of that is economically unavailable for
Right.
a procedure like this.
Sure.
Although, compared to a MIGS procedure or other things, our cost, one of our team did the analysis. Our cost per millimeter of mercury IOP reduction is the best available. So
Yeah.
on that front, it makes a lot of sense for a market with severe cost pressures. But China is so big that even when you tear off a chunk, yes, it's a substantial increase.
Well, that's all I had. Did you want to open it up for others
Happy
for questions?
to answer other questions, certainly.
Yeah, I mean, maybe another 5-10 minutes or so, we can do that.
Dave, what are you thinking that the expected cash burn per quarter is going to be going forward?
Yeah, we have not given guidance on cash burn. The closest we get to that guidance is, as I described, we expect to invest our incremental revenue or gross margin dollars, and our burn should be similar to last year's burn. If things track the way we have laid them out. The usage was up in the first quarter, so I think from that you could presume that it's going to track below that, but ultimately end up somewhere near that, call it 5.5 or so of burn. The challenge in forecasting exact cash burn is really illustrated by what happened in the first quarter. You make decisions about the business. Maybe you get a big collection, or you don't get a big collection, and the cash switches from one quarter into the next quarter when you actually receive it, and it just moves around a fair amount. It's not lockstep. We have higher expenses. For example, in addition, in the first quarter to some of the supply chain investments, I'll call them, that we made. That's when we pay our employee bonuses and do some of those cash outlays that are one time throughout the year. They happen to land in that first quarter. And in the third quarter, we may have bigger expenses for trade shows and those kinds of things. So it moves around. So we tend to kind of give a general intent for the burn as opposed to specific quarterly guidance.
All right, thank you. One more follow-up question. Are repeat probe orders increasing as a percentage of total probe sales, basically guiding towards evidence of increasing utilization rates?
Yes, they are. So we track our existing users, who's an ongoing customer, we call them, and we look at the average usage per site in ongoing customers. We also have on average. Then we also have very specific targets in each sales rep territory where they're targeting, Dr. Warwick to move him from these later stage style patients that he's using us on to include more moderate stage or pre-trabeculectomy or tube shunt instead of only after failed trabeculectomy and tube shunts. And so that how that tracks, we focus on that as evidence that we're successful in moving that particular physician to a broader. So we're starting to see increases, or not starting, we are seeing increases in those. We continue to track them and work on ways to accelerate that. The old way of looking at Iridex average usage was, let's add up all the systems that have ever been sold, look at the probe count, divide the probe count sold in the quarter by the systems and say, okay, the average usage. The average usage was getting worse and worse and worse as we placed more and more systems. Part of that was a byproduct of some of the customers never really coming up to speed on average usage. So if you had, a third that really grabbed it, a third that kind of dabbled in it, and a third that, either for whatever reason dropped it, as you place more and more systems, you get a declining average usage. We still have a number of dormant systems, as we call them, in various locations. But what we're focusing on is average usage. Of course, we're interested in bringing back dormant accounts if they look like there's an opportunity to do some significant volume. And then we also focus on maybe the dabblers to move them to, greater confidence in the procedure and selection of patients in higher numbers in a broader cohort of applicable uses, so that we get more usage there. But to specifically answer your question, we do look at the average usage per ongoing customer, and we are seeing that increasing. It's not a metric that we're confident enough in to share publicly on a quarterly basis. There's a lot of things that go into what's an ongoing customer. We only know the ordering site, for example. We don't know if that's one user or 3 users, unless our rep is in there and knows the site well. And there are some groups, for example, a university hospital center may have a number of satellite offices. The doctors go out to those offices and treat those, suburban patients in that center, but all the probes are ordered from a central location. So it's hard to pin down to exactly per user, but it's a good metric for us to measure and drive our reps and to get confidence that yes, we are being successful in increasing that average usage.
Excellent. And then I got one last one for you that came in. Are your glaucoma salespeople and clinicians having an easier time getting into hospitals, clinics, doctors' offices versus early Q1?
Yes, that's significantly improved from the first half of Q1. Because a lot of them went back to that kind of lock out the reps mode, and it was a bit of a challenge. Now, procedures were being done. There were situations where, okay, I want the support in the procedure, but I don't want someone calling on me, trying to sell me something or sell me more of something, and that has opened up significantly. I don't know that every place has opened up, but it's much better access to those clinicians here in the second quarter than it was in the first quarter.
Excellent. All right. Well, that was our last question. Once again, Dave, we appreciate you coming on and always look forward to future updates as things progress.
It was my pleasure, and thank you all very much for your interest in the company.
Some or all the speakers may maintain positions in the securities discussed in this podcast. The views in this podcast expressed are those of the speakers and not breakout investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information presented by this podcast and any liability, including in respect of direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. No one on this podcast is an investment advisor, and no one is providing investment advice. Before investing in any company's stock, you must do your own research. Thank you for listening.